We're going to calculate a dividend growth model or discounted cash flow model required rate of return for 3M Corporation. And in order to do that, we need to first get some dividends for 3M Corporation, find out what the historical growth rate is for those. So let's go to finance.yahoo.com, type in 3M and go to Get Quotes. Go to Historical Prices. Click on the radio button for dividends only, and let's do it for the last, say, 10 years. And click on Get Prices. And if you scroll down, you'll notice that we have a recent dividend of 50 cents a share, and these are quarterly levels. 48, and back on to 1998, it was 27.5 cents per share. And notice there's also been a stock split recently. Well, not that recently, in September 2003. Nice thing about using Yahoo Finance for dividends is that these dividends, this 33 cents a share, the 36 cents a share, they've all been adjusted for stock splits, and so you don't have to worry about that at all. All we have to do is download these dividends to the spreadsheet. And they're here. So we've got dividends now for 3M Corporation. And just out of curiosity, let's go ahead and check. 3M Corporation is trading for $79.67. All right, so now we have some dividends. And what we'd like to do is calculate a growth rate. There are a couple of different ways you can calculate growth rates and dividends. What we could do is we could go all the way back to 1998's dividend growth, dividend rate, quarterly dividend at 27.5, go up to 50 cents in 2008, and calculate what that growth rate is first. All right, what that'll do is it'll give you some sort of average growth rate over the whole time period, not taking into account the fact that perhaps the growth rate in dividends on a year-to-year basis is not particularly constant. But let's go ahead and give it a shot and see what happens when we do that. So to calculate this point-to-point growth rate, let's look at the dividends in 2008 divided by the dividends in 1998. And notice that that's 81%, or that ratio is 1.8181. That's 81% over a period of 10 years. We'd like to figure out what the 1-year growth rate is, and so we need to take the 10th root. So that's the same thing as raising to the 0.1 power, or I'm going to do it the more general way is raising it to the 1/10th power, because it might be something other than 10 years. For example, if it was 7, you would just use 1/7. And then what we have to do is we have to subtract 1 from that to get the growth rate. And so that growth rate is about 6.16% if we look at a point-to-point estimate. Now, another way, a little bit more sophisticated way to do this, is to use actually a regression, noting the fact that the dividend growth rates on a year-to-year basis may actually differ. And so let's go ahead and use that. That's the log_est function, equal LOGEST. It calculates a logarithmic regression. The y's, that would be the things, the dependent variables, the things that we want to predict. Those are the dividends, and so highlight those dividends. Put in a comma, and then the x's, the things that we think determine these dividends, that would be the dates. Now, one thing to notice is that Excel's dates are not these figures that you see here, 5/20/1998. They're actually listed in days. It's the days since, I don't know, the 1st of January 1990, I guess. So what we're going to get is a growth rate for a daily growth rate. So let's go ahead and do that calculation. And we get a daily growth rate of 0.0186. We could have more decimal places if we needed to. In order to figure out what that growth rate is on an annual basis, we need to, let's go ahead and do it in this cell, we need to raise this to the 365th power. That's how many, of course, days there are in a year. That gives us 1.070089, and of course we want to subtract 1 from that. Let's go ahead and do it in the equation. And so that gives us a compound growth rate on an annual basis of 7.0089%. Now the next thing that we'd like to do is to use this growth rate to calculate a discounted dividend model required rate of return for 3M Corporation. So first thing we want to do is let's go ahead and look at an equation. Remember from the dividend discount model that the price is next year's dividend divided by R minus G, or we can solve it and get R is equal to D1, which is next year's dividend divided by the price plus the growth rate. So we've got a growth rate. We'd like to go ahead and figure out what D1 over P0 is, or more accurately, what D0 times 1 plus G, because we know actually what the current rate of dividends is. We would like to know what next year's dividends are going to be. And divide by the current price. Now the current price, if you recall, is about $79, $79.67. So let's go ahead and figure this out. D1, what is D1 going to be? Well, it's the annual dividend, and so we've got quarterly dividends of 50 cents, the annual dividend. So that's 4 times the annual dividend times 1 plus the growth rate, and our growth rate is 7.0089. So there's a figure for D1. So that's about $2.14 a share per year. We've got a price, P0, which is $79.67. And so that tells us that our R value, our required rate of return, ought to be the dividend, D1, over the price, all added to the growth rate, which is 7.0089, which gives us a required rate of return of 9.69%. So if you notice, let's go ahead and figure this out, the dividend yield. That would be D1 over the price. All right, so notice we have a dividend yield of about 2.6%. We have got a growth rate of about 7%, and the sum of those gives us a required rate of return of about 9.6%.